Today we're going to talk about the active versus passive. This is clearly the perennial debate that's been going on in the investment market really for as long as I've been working in investments, which is over 20 years now, and it's a debate that doesn't seem to go away. And this webinar has really been come about because we've been asked by advisors whether we can talk about this topic, because we've got a range of different investments available, and people really wanted to get our view on where we see the debate of active versus passive. So firstly, just to introduce my colleague Matt Brennan, I'm joined by Matt today. Hi there, Matt.
Hello, Ryan. Thank you very much. I head up the passive portfolios here at AJ Bell. So friend / colleague / enemy Ryan Hughes is with me.
Yeah, I think that's probably the best to say, let battle commence. I mean, in all seriousness here, we're going to cover a couple of different areas today. We'll talk a little bit about AJ Bell Investments, for those of you that aren't too familiar with our investment proposition. And we'll talk about asset allocation and security selection. And actually, we're going to be quite sensible, I would say, about this discussion. And in fact, I'll talk about the pitfalls of active management because I think I'm the first to say it's not nirvana, and Matt will actually talk about some of the pitfalls of passive investing as well, and then we'll come to a conclusion, and you can make your own mind up as to where perhaps where your loyalties lie. But in all seriousness here, and it's important that we get across the sides, both active and passive, and we can really help you understand how we think about both sides of this market. So just a bit of background about AJ Bell Investments for those of you that don't know the investment business too well. So we were launched actually over 3 years ago now to build and manage investment solutions for AJ Bell, and that's been growing quite nicely, and we're managing over 350 million for advisors. So for those of you that have supported us, thank you very much for that. It's much appreciated. And now we have a diverse and broad range of investment solutions for you. Starting with our passive funds, we have both passive and active model portfolio solutions in both a growth and an income form. And for those of you that perhaps aren't too sure about active or passive, we actually have the creatively named Pactive MPS, which is a hybrid of the two. So a very wide range of different solutions for you to take a look at. But let's get on into the different areas here, and clearly the whole debate of active versus passive has been going on for a very long time, and in many respects perhaps the noise has picked up in the last few years as markets seem to have favoured the passive style of investing, and that's seen in some of the performance numbers in recent years, and as this image shows, I think many people view it as one or the other. In terms of which route to go down, and perhaps as we go through this, we'll talk a little bit differently about how we think about that, and perhaps some of the different choices that are involved in making, and then in the conclusion we'll draw out really how we build our portfolios as well.
So before we actually have this debate, it's maybe important to look at the wider position of how you actually put a portfolio together, and how important is security selection. Clearly it is important, but a lot of people, as they argue about, should I be using active, should I be using passive, but we think at AJ Bell it's important to actually really focus on the asset allocation as well. So in the short term, it is clear that stocks have a big effect on performance, whereas actually sometimes being in the US, being in Europe can be less important. But over the longer term, it's been shown that over 90% of returns come from getting that asset allocation correct. So it's much more important to be in the US at the right time versus the UK, especially when you have issues like Brexit and different presidents and different economic growth in different regions. And actually, over the longer term, passive, active, they all tend to follow the same big macro trends. So as I say, it is really important that when you put that portfolio together, that it is right to have that debate on passive versus active, but it's even more important to make sure you're putting your portfolios in the right areas.
And also, I think it's important to add that it's not just about getting that regional selection right, but also thinking about getting your equity and bond and property and other assets split right. And over the long term, the mix of those assets should be and will, in almost all cases, I think, be the main driver of your returns. But as we know, over the short term, is that we can get actually quite wide variability of returns across that, both and as you see in our quarterly updates on our MPS, where we talk about what's happened each quarter, is you can see some pretty wide swings around whether the US or Europe or Japan has done well, but also in the performance of equities and bonds as well. So I think we're both agreeing at the start here, absolutely, that short-term and long-term asset allocation, security selection have very different effects on our portfolios, and which is why when we come at our asset allocation, we actually come at it from exactly the same perspective, whether we're implementing that through either an active or a passive solution.
Maybe an example would help here. So through the first half of the year, the global technology sector was up 40%. Whereas a sector such as healthcare was only up 5 or 6%. So, you're talking over a 30% difference between two sectors there. You can see clearly if you're in the right sectors, in the right areas, that's going to have a much bigger driver on your overall return of the portfolio, rather than if you've used a passive ETF or an active manager. So, as I say, although that can make a difference at the edge, those two sectors and being right there is a much bigger driver of returns for portfolios. The other thing to look at is actually how the active management space works, and how active sort of drives performance. So clearly there is security selection decisions in there, but one of the things that active managers can do that the passive traditionally hasn't been able to do is really take sort of smaller sort of positions within portfolios. So, for example, you can buy companies that are sort of obviously very highly profitable, growing quickly, so known as growth companies. Or on the other hand, you can buy companies where they're unloved, in sectors such as energy, where people really don't like what's happening there. And what you see there is actually these things known as factors can add or detract from performance over a long period of time. Similarly, the size of companies matters. So you go through periods of history where large companies do really, really well. You may see that, say, through a tech bubble where you've got these really mega cap companies that are performing really well. On the other side, and through history, we see that small companies actually tend to perform a bit better over a longer period of time. So it's really important that when you're investing in active companies, it's understanding that not only are you getting security selection, you're also getting different biases in terms of style there. And these can be really persistent over long periods of time. So if we look through 2000 through to just before the financial crisis, a very, very good time for active managers where they were able to differentiate themselves away from these large companies by looking at smaller companies, looking at sort of different styles, whereas actually, post financial crisis, when everyone was panicking and everyone was looking for liquid stocks, quality stocks, actually that favored passive. So we say that it's important to note that different periods of time suit different styles, and that maybe is worth pointing out our Pactive product again to understand that's how we see that product, that we've started off 50% passive, 50% active, but when we see different periods in the market where we see active working better, where we see passive working better, we will move those weightings to adjust for that.
I think also you talk about active, Matt, I absolutely agree with those points. I think also, even thinking about passive, it's important to recognise that indices change over time. And we've actually seen a huge amount of change over the last 20 years, particularly as the sectors have changed. So if we think about technology, for example, if you're investing in an emerging market index, a decade ago, you probably had about a 10% allocation to technology, just buying the passive. If you're buying the emerging market index today, the very same index, you actually have nearly a 30% allocation to technology. And that would, of course, be true if you were buying the FTSE 100 20 years ago. It's a very different mix to what it is today. And so both whether you're buying active or passive, it's not a case of buying and forgetting, because the market changes, the passives change, active managers change. And so just as important to keep on top of your active manager is to keep on top of your passive manager and understand where your exposures lie and understand the impact that those changing indices will have on active managers to determine whether the environment suits them, as whether they should outperform or whether they might not outperform over time. So this chart here, just looking at active, this is a piece of academic research that I like using to really think about determining different styles of active management. And it's not a case of using it to prove whether active management is good or not, but it is, I think, a useful way of graphically showing where the different types of active management can come into play. And actually, when you think about fees, and we'll come on to value for money in a minute, is actually thinking about what is the right and appropriate type of active management for you. I mean, first and foremost, let me get this out there. As someone that's invested in active managers for 20 years, I'm the very first one to say that actually I think most active managers are not very good at all. If I was to put a random number on it, I would probably say that 80% of active funds in the market really are of no interest to me whatsoever, and I can't determine whether they've got any element of skill or they're just lucky. So I think there's a very small pool of active managers out there that are genuinely high quality and have the ability to deliver alpha over time. And that time being a crucial factor in this. But this piece of research here just groups different managers into 4 different areas and really makes me think about how I want to use different managers. Starting at right in the bottom left-hand corner, so we've got low tracking error and low active share. And we've got the pure indices, the pure trackers in that corner there. So very much just tracking the market, no minimal tracking error, no active share at all. And if we move one step away from that, we've got a whole group of active funds that are actually just closet index funds. They're taking very little risk versus the benchmark at all. And frankly, as an active manager, I'm not interested in these at all. If I want anything that's going to be that close to the benchmark, I might as well just buy the benchmark and save my fees. But actually, the other areas are quite interesting. So diversified stock picking with high active share certainly is an area for me where I think we can find some interesting managers. There's been a big move towards concentration of funds over the last decade. And so we see more and more concentrated funds in terms of maybe thinking about 25, 30, 40 stock portfolios rather than the very large diversified portfolios of maybe 80, 90, 100 stocks. And actually then on the bottom right-hand corner, we've got factor investing. And really, when we look at most managers, we're able to strip back and understand the different factors that they have driving their portfolio. So if we took a really simple example of a value manager, really, they have the value factor at heart. They might have very high tracking error. They might have lower active share in that portfolio. But we pretty much know, looking at that manager, that when value as a style does well, they should do well. When value as a style does badly, they should do badly. And if they don't follow that pattern, then clearly something else is at play there. But most managers, when you strip it right back to basics, have got some kind of factor exposure. And I think our job as fund researchers is really identifying what those factors are and understanding what is the right environment for that manager to be able to use them, and actually when we shouldn't be using them, or if we are using them, when they shouldn't perform well and when they should perform well, to give you that really important frame of reference so that you don't make knee-jerk decisions to sell a manager just when they're performing poorly, because quite frankly, some managers should be performing poorly at various points in time.
It's maybe worth mentioning here, so over the last decade, that those pure indexing sort of solutions, the passive solutions, have really kept the closet indexers honest. This is really what's maybe driven fees down in this area. We've started seeing more recently the passive space moving into factor investing as well. So we're now starting to see the growth of passive growth funds, passive value funds. So it will be interesting to see over the next few years how that evolves and what that means for active management. Will active management move up to the top half of this graph where we're really looking for stock pickers, or is there actually a space for active factors versus passive factors? So I don't think we know the answer to this yet, but it is certainly something to watch out for. We see Vanguard, iShares, DWS all moving into this factor space. So the costs here versus active is cheaper. There's just no history yet to back up if passively that works or not.
I think just one final point on this slide is on the closet index point. This is an area where the regulator is really, really interested, and they've been very vocal about the fact that they don't want funds that are effectively mirroring indices charging active fees for the privilege of that. And so we fully expect to see these types of closet index funds actually starting to fall away, and fund groups actually turning these into either shutting them down if they're not good product, or turning them into something where they actually take a little bit more risk and genuinely give you something for your the active fees that you're paying. The way we think about cost, and obviously a lot of people, when we think about active versus passive, it's just a simple cost discussion. Well, actually, we think thinking about value for money is far more important than thinking about pure cost. Now, this chart here is a little bit busy, but what it represents is the UK all companies sector. Each of those diamonds represents a fund, and it is simply plotting cumulative alpha over 5 years versus OCF. So anything that's got a diamond above the zero line there has outperformed the index over time. And the further you move to the right, the higher fees you've paid for the privilege of that outperformance. But of course, actually, if you were right in the top right-hand corner, you might have paid a very high OCF, but got some very good outperformance. And that might be an outcome that you're very happy with. Conversely, you might be in the bottom left-hand corner and paid a very low fee, but underperformed the index significantly. And actually, personally, I would be very happy to pay higher fees for more outperformance than I would low fees for underperformance. The trouble is in our industry is there is no evidence that the higher the fee, the greater the outperformance. But what it does show on this chart, I think, is there's actually quite a wide dispersion of both fee levels. So you've got the passive funds on the far left-hand side, around the 0 point on the fees, albeit they're not all equal there. And you've got a really wide dispersion of returns as well. But what you can see as you look right at the top above the 10% line is actually there are some active funds there that have delivered good levels of returns for sensible levels of fees. But of course, what we absolutely appreciate as an active manager is that there are many funds there that have underperformed and have charged handsomely for the privilege, and that clearly is a very poor outcome for investors. But we think value for money is far more important than pure cost. But of course, what we want to do is make sure we're only selecting managers in our active strategies that we think can outperform the index after their fees. And that's the crucial point there. We will never use an active manager where we don't think they've got the ability to deliver performance net of their fee.
I think maybe it's worth bringing in the regulator here, and obviously some of the MiFID regulation that came in terms of cost disclosure over the last couple of years. So obviously fees have been there for as long as funds have been around, but obviously much more of a focus on what you're paying and that value for money. And I think obviously it's down markets where this becomes really important. You know, people seem to not care what fees they're paying when everything's up, but it's really when markets are down. If you're paying a higher fee, but actually you've outperformed, I think people stop focusing on what fees they've disclosed and actually care much more about that performance angle. So, you know, when we've been in a bull market now for over a decade, so it is actually quite easy to just get fixated on those fees you're paying rather than the performance, because everyone's, you know, done a nice positive performance, but it's in those downward markets. And maybe Ryan can let me know if he knows any good active managers that have protected on the downside. But for me, as a passive guy, again, I'd be happy to pay those higher fees, but only if they not only outperform but protect me when markets are falling.
Yeah, absolutely right. I don't disagree on that. And just to finally just talk about the active side of things, for me as someone running active portfolios, it's not about active or passive. It's about making the right decision to implement every investment decision that we make. And so for each decision that we do make, be it an asset allocation change or a fund manager change, the thing that we think about is what's the best way of expressing that? Actually, is it via an active fund or is it via a passive fund? And therefore, in our active portfolios, we're actually completely agnostic as to how we implement the investment decision, because we only want to use active managers where we think that they've got the ability to outperform after those fees. So for each decision, each investment decision we make, we follow a little decision tree, which you can see on the screen here, which is what's the right way to implement this. Now, if it's a relatively short-term trade that we're doing or a short-term idea that we're implementing, it may well be that the passive route is a good option for that. Or if we can't find an active manager. So, for example, to express our gilt position in our MPS today, we use passive because it's incredibly low cost. And so we're very happy doing that. If we go down the active route, we're then thinking about what's the right implementation route. Is it a fund? Is it investment trust? It's very important for anyone using an MPS provider that they're using people that are whole of market and have got the ability to use both funds and investment trusts. And then if we decide to go down the passive route, it's a case then of, do we want pure beta in terms of giving us market exposure, or as Matt just talked about there, in terms of factor exposure, do we want to use a smart beta approach, or do we want to use a value ETF to give us a particular style exposure in the portfolio? So in the active portfolios, it's all about the right tool for the right job. If you look in any of our active portfolios, you'll actually find quite a bit of passive right now, because in certain areas we can't find active managers that we think can outperform over time after their fees. And where that is the case, we will absolutely use a passive manager.
So Ryan introduced the active space as saying, there's around 80% of funds that he believes actually aren't really that good. It's actually quite a similar, it's not 80%, but there's a similar theme in passive and in ETFs, where not all ETFs are created equally. And there's certainly some ETFs that give other ETFs a bad reputation. So obviously a very topical subject at the moment is liquidity, and as to what will happen when liquidity dries up, when the markets go through a shock, which inevitably will happen at some point, and more importantly, how will my passive investments perform? So our approach to passive is to sort of ignore what the headline trading costs of the instrument is, because actually when markets are functioning well and when everything's fine, these are actually often really, really tight, and it's perceived that you're getting really good liquidity for something that's actually a really illiquid asset underneath the hood. So a great example for this is small cap. So when you look at a small cap ETF, quite often the trading cost for this ETF could be as little as 20 or 30 basis points. So it appears that this is a really liquid security. Whereas actually when you open the hood on that product and look at all the individual shares underneath that ETF, the average trading cost for those products is almost 1.5%. So let's put that into context. You're paying about 5 years worth of fees to trade all those underlying securities versus that headline cost. So we really think when you're looking at passive, you shouldn't really focus on those top level costs, but really think, how much is it going to cost me to actually, if I was to not buy the ETF, if I was to buy all the underlying securities, how much would it cost me to build that portfolio? So with this in mind, when we put together our passive portfolios, we think you really, really need to focus on the liquidity of the underlying securities. So in our products, we invest in things like FTSE 100, but we stay clear of things like a FTSE small cap product. There's then a grey area in between, so areas like corporate bonds, high yield bonds, mid-cap equities, where the trading costs, will be somewhere between 0.5%, 1%. So when you invest in those securities, you've got to be really sure that you're a long-term investor, not a speculator. So when you buy a corporate bond fund, where corporate bond yields at the moment are only around 1.5%, that you're going to be holding that product for 5 years plus. If not, those fees you pay are going to take away all the returns you're going to make. So the piece of advice we would give when investing in passive is, first of all, know what you're buying and what the true liquidity of that is, and stay away from anything that is illiquid under the hood. Second of all, invest, don't speculate. Just because you can trade an ETF intraday doesn't mean you should. You should think about an ETF in the same way you would an active manager. You've taken that long-term investment decision. Trading an ETF might seem like it's low cost, but it's not when the markets move into crisis. And finally, sort of, as you say, you can't create liquidity out of nothing. So, stick with large caps, stick with liquid, and that would be really the key message.
I think for me, I think all active managers would probably concur that as you go down the cap scale, the market becomes less efficient, and actually the opportunity for active managers to find alpha should increase. And I say should because, of course, that implies an element of skill, and there'll always be some managers that probably don't have that level of skill and won't be able to deliver that outperformance. But as we go down that scale, it would be no surprise that where we find that probably our highest conviction active managers is where we get into the more inefficient markets, like into smaller companies. I think it's interesting when you think about corporate bonds, is active managers have perhaps got a couple more levers to pull. It's not just about security selection, it's also about adjusting duration, positioning, their credit quality, and so on. So when you're making an active choice in the fixed interest world, you're hopefully giving a manager a few more levers to pull to give them a chance of delivering performance. But of course, that we need to make sure that doesn't come at too high a cost for the fees as well, back to that value for money argument.
So one of the questions that always gets asked is, how much passive is too much? There's stats that, for example, in the US, we're just about to go through the tipping point where the amount in the fund industry will be as much in passive as there is in active. And the argument here is that if you've got an approach where money is just going towards the largest company, who's policing the markets, who's keeping them efficient? So point one we would make to this on the passive side is that the investment industry isn't just funds. Funds make up a decent proportion of that, but actually, you've got things like private pension schemes, you've got government schemes, you've got sovereign wealth funds. So although passive is becoming a growing part of pooled investment assets, for the total investment space, it's still less than 20% of share. But that still doesn't really answer the question, because we're just saying that we're not as far down the line as perhaps we think we are. But at some point, if it continues to grow, there will be a point where we think that, it's like the fly on the camel. They need each other. At some point, if too much moves into passive, there will be more alpha opportunities. With that, you'll get active managers who outperform. And people will therefore shift back from passive to active on the back of that. So we think it's, again, wrong to say passive versus active. It's passive and active, in the fact that, there's probably still significant more capacity for passive. But at some point in the next decade, I think we will see a balancing point where the markets police themselves. And if we go back to some of those other slides, it will be in certain areas. So, for example, small cap bonds, where there's more alpha opportunities, we think that those areas will stay much more active. Whereas if you look at things like US large cap, where there's so much information out there, these companies are so well covered, and it's actually really, really hard for an active manager to find differentiating stocks out there. We think the market can support a very high share in passive. It's also worth considering how a company actually trades on the back of its results, because obviously it's on the back of the results where shares usually go up or down depending if those results were behind or ahead of expectations. When you actually look at the volume of the company that trades on the back of results, it's typically 2 to 5% of the market capitalization. And that is obviously really driven by those active managers who are making the decision that those results were in line and they still like the stock, or something that's happened and the stock needs to be punished for that, and they're going to move away from that and hold elsewhere. So yes, the share of the company and how that works might change, but it's really important to understand how the market reacts, and actually it only takes a small amount of trading to actually really change that share price. However, what it might bring in is more volatility. So obviously, if the passive has to copy what everyone else is doing, that will force passive trading. So we think, there will be regulation that will have to be brought in to sort of obviously look after that. But as I say, we think it's still a long way away. We think there's a lot more to go, and as I say, we're not concerned at this point. But back to the previous point, it will affect different asset classes differently. So you need to make sure you're comfortable where you're using passive, where you're using active.
And I think, as we said earlier, it's really important that you understand the type of passive exposure that you've got, and how that's changing, and also how an active manager changes with that. But also thinking about any distortions that happen in the market. We're certainly seeing over the last decade average holding periods come down there, and there's lots of speculation as to whether that is to do with as passive volumes increase in the market, whether that brings down holding periods at all. Excuse me, but it's a case, I think, as Matt said, about the two asset classes, the two styles of investing coexisting. Really, they do need each other. I'm going to go away and read more about the fly and the camel after this to learn more about what Matt's talking about there, which sounds quite interesting. But it's a case of they certainly do coexist. And if we try and bring this to a conclusion, there, we certainly would absolutely see why this has been such an emotive subject for so long. But we think it's absolutely vital that both parties, both active and passive investors, understand both sides of the argument. I think too often in the debate that we see in the market and that we read about all of the time, it's so many opinions are simply presented as fact. And maybe that's actually something that's happening more and more in life, and not just about the active and passive debate at the moment. And dare we get on to anything to do with our Brexit discussions? We'll save that for another day. Security selection, absolutely important, as Matt said right back at the start, but asset allocation is crucial, and we spend a huge amount of our time getting that long-term asset allocation correct. Then it's about how we want to implement that in the different styles. As Matt said, we need each other to facilitate an orderly market. Both Matt and I perfectly accept that we probably need each other here to coexist in what we do. It's not about active versus passive. Frankly, we're all pretty fed up with the active versus passive debate, and we would much rather try and frame the debate as to how it should be active and passive, and how we can coexist together. That's exactly how we build our active portfolios today. So go away and have a look at the fact sheets. You'll see just how much passive actually is in our portfolios today, and it's also why, as a business, we're agnostic in the whole active versus passive debate. We would much prefer to give you the choice as to how you want to express your feelings for your investors, and hence we offer both passive solutions and active solutions following exactly the same asset allocation, just then with a choice as to how they're implemented. That's all we wanted to say on this topic today. We hope you found that interesting. You might be disappointed that it didn't turn into some kind of all-out brawl, but that's absolutely was not the intention. And say we do feel that there's room in the market for both sides of this. If you have any questions that you want to ask both Matt and myself, then feel free to get in contact with your usual AJ Bell representative. We'd be delighted to talk to you about it. And if you have any questions about the broader proposition from AJ Bell Investments, then do please get in touch. Thank you very much for listening.